Hi, welcome. I am Jay Taylor. Welcome to Turning Hard Times into Good Times, and I'm your host. This is the 21st day of January 2020. And as always, I'd like to remind you I'm the editor of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And you can subscribe to my letter by going to miningstocks.com. And certainly this is a good time to subscribe to my letter and other newsletter writers that are championing, at least that are researching and writing about the junior exploration sector, because now there's money coming into the sector. Drill holes are being put down, and gold deposits and silver deposits are being found. And some of them are looking very, 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 very attractive. And, of course, I write about that every weekend in my newsletter. Also like to encourage you to consider signing up for Chen Lin's letter. What is Chen buying? What is Chen selling? Chen also covers the mining sector, but he also probably a little bit up market from what I do. His subscribers tend to be wealthier and for the most part tend to be fund managers and the like, and they need more liquidity than a lot of the startup companies that I focus on provide. But ChenPicks.com is a place to go. In addition to the mining sector, Chen focuses a lot on the biotech sector, where he's done extremely well for his clients. And Michael Oliver, it's olivermsa.com. We'll be talking to Michael in just a moment. I want to thank each of you for listening and making this show one of the more popular shows on the Voice America Business Channel. Also, like to encourage you to send along any comments you might have about this show and anything that you hear on the show. We always like to hear from you. It's not possible necessarily to answer you directly, but it's always good to know what our listeners are thinking out there. Our sponsors for today's show, which I'm very thankful because without them there would be no show: Irving Resources, Sitka Gold Corp, Hannon Metals, Novo Resources, Great Bear Resources, Gatling Exploration, TriStar Gold Resources, and Lion One Metals. I've titled today's show, The Worm Begins to Turn for Unloved Sectors. David McElveny, Michael Oliver, and Nick Appleyard return as guests today. Michael has turned decidedly bullish on commodities and bearish on the dollar, even as out-of-control rising interest rates appear visible in the side view mirror. At least to a certain extent, it seems that David McElveny may be in sync with Michael's views of the market. David recently opined that the worm is beginning to turn for unloved sectors. We will ask David which markets he believes are at the turning point as 2020 gets underway. What fundamentals does he see that convinces him of these changes, and how might strife in the Middle East and trade with China and all that come into play? What impact might the Fed money pumping into the system by way of the repo markets play globally as foreign nations are pulling out of U.S. Treasury markets and U.S. deficits run further out of control? These are all questions that we'll want to pick David's brains on. Nick will provide an update on TriStar Gold Company's Brazilian mining project in the second segment of today's show. But right now, I'm really happy to tell you that Michael Oliver is with me once again. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
Always good to have you. You know, in December, you were stressing two markets that you thought were very important, namely the U.S. dollar index and the entire commodity sector as measured by the Bloomberg Commodity Index. If I'm reading your work correctly, you believe that the dollar now has begun a significant bear market, or most likely has begun a significant bear market, and commodities have most likely begun a bull market. Do I have that right?
Yeah, it's an arm wrestling situation, though. Right now, the Bloomberg is backed up over the last several days, and the dollar has rallied some. But the structures that we defined were broken in December. And the rally that we've got in the dollar since then, which is modest at best, does not negate that, nor does the pullback in the Bloomberg negate the upside breakout that it generated, because we're using pretty long-term metrics here. And so day-to-day action we ignore unless it does something, untoward, and it's not. Okay, so I think that those two categories have made a shift, subtle but firm type of shift, that will make itself felt, as we go forward. Right now, the one asset category, of course, that everybody's focused on, and I think is the next player in the game in terms of trend change, is the stock market, especially the U.S. stock market. Most of the indices around the world, like the Nikkei or the European indices, they're they firmed recently with the S&P, but nothing comparable in terms of percentage rally. The U.S. market is in what we call a mini blow-off. In a point of acceleration where the uptrend says, I want to go have a tantrum on the upside. Now, the problem with those type of events is that when they occur late in a bull trend, they usually indicate exhaustion and extreme excitement, and therefore they're dangerous. That's not occurring in the Nikkei or in the DAX index in Germany or the Euro Stoxx 50. They're firm, but they're frankly they're where they were in 2015. Okay, so those markets are at best afloat. That's about all. Our market's the one that's the U.S. market, the one that's gone parabolic, and it's our view that with not much flinching. And we've got some metrics that we came out with in our all-asset category report this weekend, a measurement of the relationship between the NASDAQ 100, which is the leadership index of the U.S. It's all front-end loaded with all those stocks you can name, 4 or 5 of them, Apple, Microsoft, and so forth. Comparing that to its performance versus the S&P, and when you measure that spread difference and the momentum of that spread, we've got some numbers not far below the market in terms of that particular spread relationship that would indicate, okay, we're beginning to the downside. And so we're on top of that. And I think when that occurs, that's likely to shake out more money out of the stock market into other categories. And for a while, I still think that could go into the T-bonds, German bonds, JGBs, as a flight to safety type thing, although I don't view that as a long-term persistent alternative, and into gold. So I would be watching, right now I'd be watching the S&P 500, the NASDAQ 100, especially the relationship. Because if that spread relationship shifts, disfavoring the NASDAQ, favoring the S&P, it means that the leadership is failing on a performance basis. And we've got some structures below that look like when it cracks, it could really start down hard. So anyway, everything's great in the world, and just buy, right? Okay.
Oh, that's everybody's all in because the Fed has your back, right? I mean, we just know with the Powell pivot now, it's pretty much guaranteed.
Well, there was a Bernanke pivot too. Back in the summer of 2008, summer of 2007, August, we had a big sell-off in the S&P. Bernanke came in with guns ablaze and said, I'm going to lower rates and open the window for all kinds of stuff you can use at the Fed discount window, like mortgage-backed securities. And we know that stopped that market from going down, didn't it?
I guess not quite. So I guess because the NASDAQ 100 has all those really, really huge companies in there, I guess when that thing starts to go, it could really go fast, right?
I think so, yes. Our spread analysis of that particular relationship between NASDAQ and S&P has been quite good over the last year, both in calling downside and calling upside. Right now it's pending a major downside break point, and we're watching it day by day, therefore. And I think when that snaps, my strong suspicion is that gold, which is up here picking its teeth above the highs of last summer. By the way, everybody who's nervous about gold shouldn't be. Take a look at the price chart. It surged above last year's highs, and it's gone to sleep here for the last 4 weeks above those highs. So it's comfy up here. It didn't gain ground and then collapse. It gained ground and held it. So I think it's waiting on the next little snap, and I think that's going to be from the stock market.
Yeah, it's hard for me to see how that could happen. Going back, Michael, you did a great service for your subscribers after the peak in 2011. You got them out, not exactly at the top, but I don't know, it was $100 or so from the top. It was a lot better than when I finally got out. Well, I never did, actually. I wrote it all the way down from 1,700 to just a little over 1,000, right? Was the bottom? But back at that time, something came to mind just recently that happened was that the Fed started the twist, where they sold the short end and bought the long end of the curve. And one person's theory was that convinced the market that with the T-bond rates collapsing, that there was no worry about inflation, so therefore they sold gold. And do you suppose, I don't know if that's the reason, I'm sure always there's many different reasons why people do things and why they make decisions to buy or sell. But if that in fact was a major factor, I'm wondering if that might not be something that gold investors should be on the lookout for sometime in the future. If we start to have rising interest rates and the long bond starts to rise, as I believe you think is very possible here in the future, especially if we start having some serious commodity inflation, which I think you also think is a possibility, then, there's always tricks these guys can play to try to rip the rug out from underneath you, right? So I just want your thoughts. I know that you focus on the, from a technical perspective, and that you're not concerned about different reasons why things do what they do. That becomes apparent sometimes later. But I guess it's always possible. Nothing is a one-way street forever, even though right now everybody thinks that not everybody, large percentage of people, probably smaller investors, think that you can't lose in the stock market.
Mm-hmm. Oh, well, right, the Fed does manipulate things, and when they do manipulate things over the last decades, and now more recently, the extreme manipulation, not just by the Fed, but the ECB and the BOJ, has boosted equity prices. In fact, the BOJ is an owner of stocks. I think they own like more than 10% of the ETFs over there. Anyway, their intent was to buoy stocks. Bernanke stated it outright. One of the policy goals was to boost stocks to create sentiment. So the consumers would go out and spend their money, not save it, which is a lunatic idea. But anyway, they did it, and it worked. Well, it worked because the S&P had collapsed from 1570 down to 670 between the 2007 high and the 2009 low. And so naturally, at that point, it made sense from a price point of view that, okay, we've got a bombed-out market here, so it could go up. Now, so, maybe the first half of the bull market in terms of price, up to 2015, let's say, was justified. It wasn't excessive. But then everything since then on the U.S. stock market has been, squeezed out of the tube, I think, to a point of excess. So I think the Fed has created another bubble situation, this time equity markets. Prior, it was real estate markets. This time it's equity markets. And I think when that comes undone, they will not be able to stop it. They've not been able to stop their prior bubble bursting, 2000, the 2007 burst to real estate market. So when it comes undone, despite the fact they continue a policy to try to save things, it doesn't work because the excess was too excessive. And when it comes unwound, there's a thing called Mother Nature. And I think we're at that point now, but I think the excess now, instead of like real estate or whatever, or .com, it's now the stock market, especially the U.S. stock market.
Yeah, and, for sure. And some people would say it's also the treasury market or the bond market. And I think your technicals, though, Michael, are bearish long-term for the T-bond. Am I right about that?
I think that the T-bonds, they're dangerous to be short because if you get a rapid, brief stock market slump as part of a broader slump, how the stock market can do it fast occasionally. When that happens, the flight to safety into T-bonds, into bunds, into JGBs will occur. And if you're short those markets, you'll be skewered. However, I doubt that those rallies, when they occur, will be sustainable, meaning that once we get one of those spike rallies again, flight to safety, I think that alternative, namely the government bond market, will cease to be attractive to investors, in which case you're left with pretty much only one area, and that's the broad commodity category, which is totally bombed out. It's not going down anymore. The issue is up. And the gold market. And those are fairly small arenas compared to the global stock market and the bond markets. So, if all of a sudden everybody wants to grab hold of a position in those areas, commodity-related stocks, commodities, gold, etc., it can be quite a wet bar of soap. So or akin to Niagara Falls through a garden hose or something like that. Right. Well, all right. Well, we'll have to leave it go at that, Michael. Thank you so much. Again, always a pleasure to have you on. And in a couple of weeks from now, we hope to do it again. All right? Thank you, Jay.